Hello, I'm Juliet Sarli. In this week's edition of IG Macro Intelligence, we take a deep dive into the travel sector. Policy changes under the Trump administration have led to a notable decline in international travel to the US. President Trump's Executive Order 14161 has seen enhanced vetting at US borders, resulting in cases of tourists being denied entry. Tourism Economics is projecting a 9.4% decline in international visitation to the US in 2025, a stark revision from its earlier forecast of an 8.8% increase. The downgrade could potentially result in $9 billion in lost revenue, according to economists. Meanwhile, the International Trade Association estimates that every 40 international visits to the US supports one American job. Flight Centre has seen US travel bookings fall by 12 to 15% in early 2025, with expectations of a continued downward trend. And Intrepid Travel reported a 13% drop in US sales among Australian and New Zealand customers, with April alone showing a steep 44% year-on-year decline. The downtrend is sparking analyst downgrades in the travel sector.
Quite bullish on travel for the last few years. That bullishness ended the day I started hearing stories about people being stopped at the borders in the US and then turned around. Regular tourists who had a long conversation with the border guards and then were denied entry to the United States. That's got to impact inbound tourism in the United States and then a knock-on effect to travel elsewhere in the world.
Shares in Flight Centre are down 22% year-to-date and have lost more than 34% over the past 12 months. At the recent Macquarie Investor Conference, Flight Centre indicated heightened uncertainty is likely to continue throughout 2025, and it's not expecting stabilisation until 2026. Flight Centre revised its 2025 financial year profit guidance from $365 to $405 million down to $300 to $335 million, claiming that US policy changes are impacting business and consumer confidence globally. Following its recent trading update, UBS cut its forecast for full year 2025 and full year 26 earnings per share forecasts for Flight Centre by 14% and 15% respectively, but the broker does maintain a buy recommendation on the stock with a $15 price target. The average price target on Flight Centre, $16.50 according to Refinitiv, with most brokers suggesting that you do buy the stock. And despite a recent rally that pushed shares into overbought territory, ASX TradeWatch data show the stock remains in a broader downtrend. Meanwhile, Corporate Travel Management recently forecast revenue to drop by 4% below its previous forecast, citing economic uncertainty around the tariffs. It says it's witnessing a slowdown in client activity in what is traditionally the year's busiest period. Shares have also been under pressure over the past 12 months, and Macquarie cut its target price by 25% to $13.07 in the wake of the update from the company, Morgan Stanley cutting its price target by 23%. Andrew Dale from ECP Asset Management telling AusBiz the recent warnings from travel companies could be just the tip of the iceberg.
We see here with travel companies is a real, they're very leveraged to volume. So when you see any weakness coming through, it falls through to the bottom line. So typically these companies are sort of canaries in the coal mine. They're predicting what's going on in sentiment, what people are doing, businesses pulling their horns in, not willing to spend, the CapEx cycle starting to crimp. We would normally see this flow through into broader economic aspects.
When it comes to the flying kangaroo, Jefferies analysts believe falling oil prices and a lower US dollar as a result of Trump's tariffs have actually improved the outlook for Qantas. The analysts have retained their buy rating on the airline and increased their target price to $11.97 from $11.42, adding that demand for Qantas and its budget unit Jetstar have remained solid in the domestic travel market. Macquarie analysts add the airline is yet to see any impact on the US in and outbound demand travel, and that yields are still strong. The average target price on Qantas is $10.38, according to Refinitiv, suggesting the stock can rally a further 5% from current levels. And similarly, technical indicators point to a strong bullish trend in the stock. The 5-day moving average is sitting above both the 20 and 50-day average, and the 200-day moving average is also trending upward. Still, analysts are advising overall caution in the sector amid the geopolitical uncertainty.
blunts what has been a pretty good 3 or 4 years for the travel sector post COVID. It might be temporary once the bureaucracy stops being scared about how to manage these flows. But yeah, I'd stay away from that sector for the next year or so.
And that is your IG Macro Intelligence for this week. We'll see you next week.